Hello and welcome to Finance Explained. This is our weekly global market news update, your concise and insightful briefing to kickstart the week. I'm Amanda and today is Monday, May 5th, 2025. In this episode, we'll delve into the key market movements from last week, explore the economic indicators that are shaping investor sentiment, and highlight the sectors and assets to watch in the coming days. Whether you're a seasoned investor or just starting your financial journey, our goal is to provide you with clear and actionable insights to navigate the markets confidently. So, let's dive in and unpack what's driving the global financial landscape this week. Firstly, we're going to look at key global indices. In the US, Wall Street commenced May on a positive trajectory, defying the traditional sell in May adage. The S&P 500 surged by 82.54 points, or 1.5%, closing at 5,686.68. Notably, all 11 sectors of the index ended in the green, with financials, industrials, materials, and technology leading the gains. The Dow Jones Industrial Average and the Nasdaq also experienced gains, reflecting investor optimism fueled by robust economic data and easing concerns over trade tensions. In Europe, and in particular in the UK, the FTSE 100 closed at 8596.35, marking a 1.17% increase. This uptick was driven by strong corporate earnings and positive sentiment in the banking sector. Germany's DAX and France's CAC 40 also posted gains, buoyed by favourable manufacturing data and investor confidence in the Eurozone's economic recovery. In Asia, Asian markets mirrored the global positive trend. Japan's Nikkei 225 climbed by 2.18%, closing at 36,830.69, as investors reacted positively to domestic earnings reports and a weaker yen. Hong Kong's Hang Seng index rose by 1.74%, and China's Shanghai Composite remained steady, reflecting cautious optimism amid ongoing trade discussions. Next, we're going to have a look at the macro headlines. Central banks in focus. This week, attention turns to major central bank meetings. The US Federal Reserve is set to convene on May 6th to the 7th, with expectations that it will maintain current interest rates at 4.25% to 4.5%, despite pressures from President Trump for cuts. The Federal Chair, Jerome Powell, has signalled caution, citing economic uncertainties stemming from tariffs and immigration policies. In the UK, the Bank of England is anticipated to reduce interest rates from the current 4.5%, responded to concerns over the economic impact of the US tariffs. A 0.25% cut is widely expected, though some economists advocate for a larger 0.5% reduction to support the slowing economy. Trade tensions and economic indicators. President Trump's recent announcement of a 100% tariff on foreign-produced films has reignited trade tensions, particularly affecting media companies like Netflix and Disney. This move adds to the existing strain on global markets, already grappling with the broader implications of US tariff policies. The US economy contracted by 0.3% in the first quarter, marking the first decline in 3 years. While consumer spending and the services sector remain resilient, the contraction underscores the challenges posed by ongoing trade disputes. Inflation trends. US inflation has shown signs of easing, with the annual rate falling to 2.5% in March from 2.8% in February. The next Consumer Price Index report is rescheduled for the release on May 13th, providing further insight into inflationary trends. In the UK, inflation dipped to 2.6% in March, down from 2.8% in February also. Despite this decline, the Bank of England projects a temporary rise to 3.7% due to increasing energy and food costs. Oil market developments. Oil prices have declined over 1% following OPEC Plus's decision to accelerate production increases, raising concerns about oversupply amid uncertain demand. US crude oil prices fell by 2.6% to $56.75 per barrel, marking a 4-year low. Currency movements. The Taiwanese dollar surged nearly 6% over 2 sessions, reaching a 3-year high. This appreciation is attributed to speculative inflows and potential revaluation efforts aimed at securing US trade concessions. Next, we're going to have a look at sector highlights, where we'll cover technology, financials, energy, utilities, consumer discretionary, and international markets. So first up, technology. The technology sector experienced a mixed performance today. The Technology Select Sector, SPDR ETF, that's XLK, saw a slight decline of 0.45%, closing at $215.63. Notably, major tech stocks such as Apple, Nvidia, and Tesla face significant losses, contributing to the sector's overall downturn. Financials. Financial stocks demonstrated resilience, with the Financial Select Sector, SPDR ETF, that's XLF, edging down by 0.24% to close at $49.64. The sector's fundamentals remain strong, supported by stable interest rates and robust economic indicators. Energy. The energy sector faced headwinds as oil prices declined over 1% following OPEC Plus's announcement to increase production. The Energy Select Sector SPDR Fund, that's XLE, dropped by 1.61%, closing at $80.66. This decline reflects concerns over potential oversupply in the market. Utilities. The utility sector is under scrutiny after Warren Buffett cautioned investors about the declining reliability of electric utility stocks. He highlighted the increasing risks associated with wildfires, which have led to significant financial liabilities for utility companies. Consumer discretionary. Consumer discretionary stocks showed modest gains, buoyed by positive economic data and consumer spending trends. Retailers and hospitality companies benefited from increased consumer confidence and spending. And finally, international markets. In India, the Nifty Auto Index surged by 1.85%, indicating strong performance in the automotive sector. However, the Nifty Bank Index experienced a slight decline, reflecting mixed sentiments in the financial sector. So what does that mean for investing? Let's firstly look at navigating the current market landscape. As we progress through 2025, investors are contending with a complex macroeconomic environment characterised by persistent inflation, evolving trade policies, and sector rotations. Understanding these dynamics is crucial for making informed investment decisions. Sector rotation, identifying opportunities. Recent market analysis indicates a notable rotation in sector performance. While technology stocks have experienced some volatility, sectors such as financials and energy are showing resilience. This shift suggests that investors are repositioning their portfolios in anticipation of changing economic conditions. The role of alternative investments. In the face of traditional market uncertainties, alternative investments are gaining traction. Private equity, infrastructure, and real assets offer diversification benefits and potential for stable returns. These assets can serve as a hedge against inflation and market volatility. Emphasizing quality and resilience. In uncertain times, focusing on high-quality investments with strong balance sheets and consistent earnings can provide stability. Companies with robust fundamentals are better positioned to withstand economic headwinds and deliver long-term value. So what's the conclusion? The current investment climate demands a strategic approach that balances risk and opportunity. By staying informed and adaptable, investors can navigate the complexities of the market and position their portfolios for sustained growth. And that wraps up this week's Global Market News Update. From sector shifts to macro trends and investing insights, staying informed is your best asset in a dynamic market like this. If you found this breakdown helpful, don't forget to like, subscribe, and share it with someone who needs a quick yet insightful overview to start their investing week strong. I'll see you next Monday with more key updates and angles from the global markets. Until then, stay curious, stay focused, and keep investing with confidence. Thanks for watching.